Good afternoon, everyone. We're just going to give people a few more minutes to jump into the go-to system. So I will go on mute and we will just start in a few minutes.
Hi everyone. So thanks for joining us for today's installment of our webinar series. My name is Gemma Weeks. I'm a business development manager here at ETF Securities, and presenting for you today is my colleague Kanish Chugh, and he is our head of distribution. And Kanish is going to be looking at investing in modern healthcare with biotechnology. Now, before we start, I just wanted to highlight our disclaimer. And really within this, I just wanted to make sure that everyone's aware that this presentation does not take into account your personal needs or financial circumstances, and you should seek independent financial, legal, and tax advice before considering any investments. Some housekeeping for you all today as well. So you will see in the go-to application that there's a number of handouts available for you. So we have the Cure product flyer. So Cure is the biotechnology ETF that we're going to be talking about. A white paper on whether biotechnology should replace healthcare, and the investment case for biotechnology, the product fact sheet, and we also have a number of resources available on our website as well, at etfsecurities.com.au. And just finally as well, we are going to be taking questions today, so you will see the questions option in the panel there. Please feel free to send them throughout the presentation, and we will leave some time at the end to run through those as well. So with that, I will hand over to Kanish.
Thank you, Gemma. And welcome everybody. Now, just so we're aware as well, this is the second webinar that we're hosting this year. The first webinar we held last month was actually on battery technology and the green revolution. So make sure you do look out for the resources section on our website if you do want to see previous webinars and any other content and collateral that we do host on our website. But today's webinar, as Gemma mentioned, is wanting to delve deeper into the industry that is biotechnology. It's been, I think, quite well discussed and reported on in the past 12 months, given the COVID-19 pandemic. But within this webinar today, I wanted to touch on a few different areas, and that is really trying to identify what is biotechnology and sort of potentially buffed a few myths, look at the biotechnology industry and its future prospects, and also go beyond COVID-19. I think a lot of people have spoken about COVID-19, but I really wanted to take it a step further and see what else does biotechnology actually give you exposure to, and what does the future look like. And finally, and most importantly, it's trying to identify how to invest in biotechnology and incorporating it within your portfolio. Throughout today's presentation, I'll be referring to the ETF Securities S&P Biotech ETF, and the ASX code for that is Cure CURE. And this particular ETF tracks the S&P Biotechnology Select Industry Index. Now, thinking about it in terms of healthcare and biotech, I want to just take a step back first and actually look at it from a perspective of how we identify what a structural theme is versus a cyclical theme. And the best way to think of it is structural themes are long-term opportunities driven by powerful transformations in our economy and society. What we can identify as long-term opportunities or structural themes are things like broad healthcare, and within that actually the driver of that is actually biotechnology. And other structural themes, what we're identifying now is other megatrends, things like robotics and automation, battery technology. If we were to look at in terms of why these structural themes are now becoming more prevalent and more in focus, and why developments and innovation are happening within certain of those structural themes that I discussed, one thing to consider is the idea of two different laws or two different theories. One is called Wrights Law, and the other one is Moore's Law. So firstly, on Wrights Law, this is a theory pioneered by Theodore Wright in 1936, and essentially it aims to provide a reliable framework for forecasting cost declines as a function of cumulative production. So specifically, it means that for every doubling of units produced, costs will fall by a constant percentage. So as you're producing more, you're also innovating, the cost of producing such things will come down. So for example, for Theodore Wright, he discussed the ideas of the factors affecting the cost of airplanes. And with every doubling of airplane production, the labor requirement was reduced by 10 to 15%. Part of that is just knowledge, so increasing knowledge and increasing efficiencies. And on the right-hand side, we've actually got Wright's Law in practice. Now, this is specifically for lithium ion. And as I mentioned, we do have a battery technology ETF. The code for that is ACDC. But this specifically looks at the lithium ion battery market development for electric vehicles. And as the price starts to come down, the demand starts to come up. So that theory of Wright's Law, we learn by doing and costs decrease. The other law of theory I wanted to focus on was the idea of Moore's Law. And this is actually, if you look at this chart here, it's specific to biotechnology. So Moore's Law is coupled with Wright's Law, and Moore's Law essentially refers to Moore's perception that, and it's actually specific to microchip and semiconductors he actually created this theory for, but it actually can be applied to many other industries and areas. But his theory was that the number of microchips or transistors on a microchip doubles every year, and though the cost of computers is halved. So it states that we can expect the speed and the capability of our computers to increase every couple of years, and we will in theory pay less for them. So what this essentially shows you is, if we applied it within the biotechnology space, let's consider the cost of the human genome. Now, mapping the human genome is essentially what has driven modern biotechnology. The idea of mapping the human genome was roughly around $100 million in cost back in 2001. Let's fast forward 20 years, and the cost to map a human genome is on average around $1,000. Now, this is important because what it actually does is this use of technology, this advancement and this innovation in technology and the mapping of the human genome has actually allowed biotech companies to continue to really grow in their research and development to try and identify new vaccines, treatments, and diagnostic services and tools. Now, within biotech, what I wanted to try and identify was, is it really the future of healthcare? Again, looking at that idea of structural themes and cyclical themes, I wanted to identify some broad disruption and trends that we generally see. And these are things like technology, the future of computing, whether it be using the increasing advancement of big data, Internet of Things, etc. Shopping, we've obviously seen a big trend shift in the past 12 to 18 months, especially as a lot of people have been in lockdowns and working from home. The idea of changing productivity and the use of robotics and automation. And I've spoken about the idea of the energy area, energy space and the energy industry really being transformed because of battery technology. But the area that I wanted to focus on today was obviously healthcare, and looking at it and trying to identify where the drivers of healthcare exist, and that essentially is within the biotech space. So when we consider healthcare, now healthcare it's known as essentially an industrial sector is what it is normally referred to. It's quite diverse, it's quite broad, and has many subsectors within that. And I've tried to identify those here being biotechnology, pharmaceuticals, healthcare services, healthcare equipment, and life sciences. What we generally find is that investors, when they look at healthcare, they generally say, well, I want to invest in healthcare for the growth, I want to invest in it for the diversification. But as an industrial sector, where are you going to be getting that growth from? And what we've actually found is the growth that we've seen within healthcare has actually been driven, especially over the past 5-10 years, from biotechnology specifically. Now, biotechnology is a sub-industry of the healthcare sector, and within biotechnology, it actually captures companies that focus on research and development, manufacturing and or marketing products based on a biological or genetic information. So within modern biotechnology as we know it, there are different types of biotechnology, including the biological drugs, so in the form of protein and peptides. So they're different working mechanisms to traditional chemical drugs. What's obviously on everyone's minds are vaccines, and this is really a cornerstone of modern biotechnology, and we'll discuss how the vaccine area of modern biotechnology has really helped with COVID-19 and development of vaccines. The idea of immunotherapy, so the use of monoclonal antibodies, and they can attach to cancer cells to flag white blood cells to destroy them. So really within the cancer area, there are a lot of therapeutic drugs that are being developed by biotech companies, and we'll discuss a few of those later on. Also looking down the line in terms of modern biotechnology, the idea of gene therapy. So looking to introduce harmless viruses with modifying genes that essentially release a protein that someone cannot naturally produce. So building up, again, people's immune system and helping trying to identify, weak cells. Then looking at orphan drugs and genetic engineering. So within the orphan drugs, this was something that was new to me when we launched this fund 3 years ago. But essentially, the idea of orphan drugs is the treatment of a rare disease. Now, a disease is identified as being rare of when it's affecting a very low percentage of the developed world. So these could be diseases that are actually affecting quite a large majority of communities and people within developing worlds and emerging markets, but the cost of developing treatments for them, vaccines for them, etc., is quite high. So generally what you find is biotech companies traditionally would not focus on these. As we've discussed, with the cost of the human genome mapping starting to come down, the use of technology, innovation constantly being developed, biotech companies are able to now focus on rare diseases and develop orphan drugs. And finally, the idea of genetic engineering. So this is sort of the latest in biotechnology, the idea of editing DNA with high precision using the CRISPR technology, which again is one of the reasons why we've seen this big growth in modern biotechnology. I guess it's important to note also that it may sound like a newer industry, we talk about it being modern, etc., but biotechnology has a very long and rich history. Starting with, if we go back nearly a century, the creation of penicillin was actually in fact a form of biotechnology. And as we've discussed, these continued improvements in technology over time, they've helped benefited this particular subsector. They've enhanced the ability to access and analyze certain biological processes. Within this particular industry, it's interesting because when looking at this particular slide, it essentially shows you, from the discovery stage all the way to the commercialization, the different steps that a biotech company has to go through when developing a particular drug. From the preclinical stage to the regulatory meetings to the trials and the many trials, which often can take years. Finally, to going through the different phases of the drug agency processes and approvals, getting to that final, if it's within the US, that FDA decision, that final FDA approval, allowing them to commercialize it and sell on this particular drug that they've been developing. What we generally find is it's a high-risk industry. So there are high costs with drug development, and there's high chances of failure. So the rewards for a successful trial can be immense. But I think what we have found is the big focus that COVID-19 has applied within this industry in particular to allow certain red tape to be reduced, the money that is being put behind some of these particular drugs has been enormous. And so you generally find that, and this is my personal opinion from where I sit, looking at this particular subsector of biotechnology, is this particular drug development process, yes, it will continue to take a long time, but I do believe that the amount of time from discovery to commercialization may start to get streamlined as we've had certain experiences in the development and the process and the trial process of COVID-19 vaccines and therapies. Further, to try to identify and understand this industry really, and it comes down, and it will make more sense in terms of when we're talking about investing in biotechnology, why there is a suggestion to look at a diversified basket of stocks, such as via an ETF, instead of trying to pick winners or losers, is because we've talked about how the development process can be very long. What I didn't mention, obviously, was the failure rate, which is extremely high. So if I was to put this in perspective here, this particular slide, in any given year, 54% of clinical phase 3 trials typically fail for a range of reasons. And the average cost for developing a drug, it's estimated to be roughly around US $2.1 billion. So if the trials and approvals can take many years, often at this point in time, pre-COVID 10 years, what they have found is less than 12% of drugs are reaching that approved status within the FDA. Now, biotech and healthcare companies, they derive some of their revenue from the approved products, obviously the commercialization stage. And there are many companies within the Biotech ETF Cure, which are commercializing multiple different types of drugs for many different areas. You've also got companies in there, though, that are really just focusing on one particular area of study, whether it be cystic fibrosis, for example. And what you find is they've got one drug, and that is all they're focusing on. Now, they derive revenue from, obviously, the commercialization, but they also derive revenue from selling on some of those patents, either during the drug development process or once the drug development process has reached its approved stage, and selling on. You also find there are companies, and there are some companies within the Biotech ETF, that obviously take advantage, and a lot of large pharma companies actually do this. They take advantage of when patents expire, and they look to commercialize and make generic versions of those treatments. But by that stage as well, what you generally find is those biotech companies that had those patents, they're obviously taking the success of that successful treatment or successful drug that they've developed and looking to focus on other areas. Within the biotech, we've talked about the failures, and we've mentioned, there's about a 12% success rate just to be approved. But in saying that, with the many drugs that go through that approval process, there are some very unique and amazing success stories. And so I wanted to discuss a few of those here because, again, a lot of people are very much just focused on COVID-19. So I've put up on this particular slide 4 drugs that were approved during different times in the past 25 years. We have a drug called Avonex, which is from a company called Biogen. Now, this particular drug helps treat multiple sclerosis patients. The full year on multiple sclerosis drugs from Biogen was roughly around $8.7 billion US. Now, this particular Avonex drug was the first drug that Biogen developed to help with multiple sclerosis MS patients. It generated sales in 2020 of $1.5 billion US. So what actually this drug allowed Biogen to do was it gave them the entry that they needed to develop further drugs and further treatments around multiple sclerosis. So whilst Avonex is a very successful drug for Biogen, it is now not the only drug that they have within this particular area. Moving down to the right, you can, when looking at Amgen, for example, developing a biological drug called Neulasta, and again, it's for a therapeutic drug targeting for chemo patients. Now, for the 4th quarter, total revenues increased across Amgen by 7% to $6.6 billion US in comparison to the 4th quarter of 2019. Now, within specifically Neulasta, they actually saw $2.3 billion of sales just from this particular drug alone. And then finally, I wanted to actually touch on this particular drug. It's the smallpox vaccine. It's by a company by Emergent Biosolutions. It's why I wanted to speak about this is the smallpox vaccine it's not a new vaccine, but what has occurred is as that patent has expired, there are companies like Emergent Biosolutions which have taken that smallpox vaccine and continually developed, and also smallpox at the moment as a treatable disease is small in size, so the market for a smallpox vaccine is relatively small. But you've got companies, again, within the Cure ETF that are focusing on these types of diseases, and they're focusing on vaccines and treatments for them, and they generated about $129 million of sales just from this one particular drug or this vaccine, which goes by the name of ACAM 2000. Going further down the line of the success stories and then and now, wanted to just give everyone a snapshot of where the biotech industry actually sits and the changes that has occurred over the past 11 years, and wanted to try and identify these changes by looking at the market cap or the size of the companies within the top 10 of the index that we are tracking. So on the left, it's a snapshot from the end of December 2009. And you can see there, Amgen, Gilead Sciences, Celgene Corp, Biogen, which is a company I mentioned. For some of you that are interested in this space, or some of you will have heard of Amgen, especially in 2020, you can see that they're not small companies, but they are relatively small when you look at it, when we look at the top 10 now and the snapshot on the right, which is the snapshot from the end of October 2020. So some similar names still at the top in Amgen and Gilead Sciences. You can see there that Gilead Sciences has close to doubled. Amgen as well has more than doubled in its market cap. But companies like AbbVie wasn't even in the top 10, is now the largest within the biotech subsector at 150 billion. You've got companies like Insight Corp or Seagen, for example, companies that weren't in the particular top 10 in 2009, and to be frank, may not have even been around at that point. So you can see now how much the biotech industry has changed over the past 15 to 20 years. By the way, just as another reminder, if you do have any questions and you want to ask them, please feel free to use the question panel in the GoTo system. We've talked about some of the success stories, and we've talked about some of the companies and the successful companies that exist. But what about the future blockbusters beyond COVID-19? And I'm going to talk about COVID-19 in a minute, but there are a lot of drugs that are sitting in that drug pipeline. There's actually quite a number of drugs. Probably the number of drugs sitting in that drug pipeline has increased over the past 12 months, partly because there were a lot of drug development trials, etc., that were put on hold. So companies, hospitals, the authorities could focus really on treatments and vaccines for COVID-19. But these are just some of the future blockbusters, as we could call them. You know, there are drugs sitting here looking across a range of different areas, from rheumatoid arthritis to looking to treat breast cancer to treating peanut allergy, which, if you have kids, can be quite a scary thing when you start to send them to school or childcare. When we look at COVID-19, and we talked about the mapping of spreads with genomics, partly of that, and talked about the cost of the human genome and the mapping of the human genome and the technology innovation that's occurred. What we have actually seen is a real use of this technology, and last year represented this. So the ability for governments, regulatory bodies, hospitals, etc., to be able to start to map the spread of COVID-19 and the specific strains has helped certain countries, especially Australia, for example, to their ability to try to tackle and fight against the particular virus, and hopefully allow us to have a much more positive outcome at the end of it, and we're sort of nearing that sort of stage where we're starting to see the vaccine rollout. Now, within Cure, the Biotech ETF that we're discussing here, there is some exposure to COVID-19, and when looking through it, we identified roughly around 22 companies, or 19% exposure that sits within Cure. So these are companies like Alexion. Now, Alexion has a drug called Solaris, and it's an experimental emergency treatment that's actually being used to treat a small number of patients with COVID-19 infections. Or, highlighting another company here, AbbVie. Now, AbbVie's partnered with global authorities. Now, AbbVie produces a number of HIV medicines, and they're looking to partner with global authorities to see if some of these medications can help treat COVID-19. What I found within looking at the biotech industry and the companies that are working on COVID-19, you had companies that are working on vaccines, such as Moderna is probably the most well-known one, or you had companies that are working on treatments to help simply just treat the effects that COVID-19 may have on patients. But also you had companies within the biotech industry working on diagnostics as well. And that was, again, a very important aspect to helping us tackle the virus. So when we talk about COVID-19, how has that impacted the way health spending is going to occur? So essentially, if you look at the upwards pressure, there is the COVID-19 response, the vaccine rollout. So that real focus that the pandemic has applied. There's the consequences of I guess, foregone care, sorry. So the idea that we talked about, when we're thinking about COVID-19 and the focus that it's had, it's essentially taken away from some of the trials that other drugs were running through or the development process. But there has been some downward pressure as well. So from an economic contraction perspective, there's been increasing unemployment and foregone and debt service obligations obviously And we've seen that generally across across the markets across the world. And we even have seen that more recently with increased lockdowns in Europe and also within the UK. But post-COVID-19, what does the future look like? So we talked about the ability that COVID-19 has had on centralizing everyone's focus. I wanted to really put this in perspective, and you can see on the chart on the left here that idea of vaccine development. And we went from taking close to 20 months to developing a vaccine. So going from the viral, mapping that viral genetic sequence to the first human study was nearly 20 months with SARS back in 2003. With the Zika virus, it was considerably less, at roughly around 3 to 4 months. But with COVID-19, it was a very quick response. And part of that was obviously the impact that the pandemic had, but you can see there that when mobilized, this particular industry and government's alignment can really do wonders. And so that takes us to looking at healthcare spending. So as a result of COVID-19, I think we will see increased financial spending. Now, an example of this is the national spending growth in the US is expected to average roughly around 5.4% annually through to 2028, reaching roughly around $6 trillion. And biotechnology, given it's at the forefront of innovation of vaccine development, treatment of diseases and other viruses, and diagnostics, will be at the forefront and beneficiary of that investment. Within the biotech sector, I wanted to just touch on where the growth is. And this is important because essentially within the biotech companies, there remains a source of growth despite the massive downside revisions that the broader healthcare market has somewhat had. In 2020 alone, you do see a increased innovation. And the ways in which we can identify this is through looking at, for example, the number of biotech companies that listed. I believe it's one of the highest on record in the past decade. They had 82 biotech companies that went public on the NASDAQ exchange in the US, raising close to $15 billion. So this IPO market activity, seeing that strong momentum, there's been a record number breaking number of deals and capital raised. Just moving away from the public area and the publicly listed companies that we have there of those 82, you've also seen an increase in private market investments. And all it's doing is it's setting biotech up well for future IPOs and a higher follow-on financing going into 2021. Looking beyond just the IPO, we talked about some of the mergers and acquisitions, and that's something that we do see within our biotech ETF is a number of companies, and you generally will find that as a company is developing a drug, especially if they're very small in size, they will be acquired or merged in with a larger company. So the second half of 2020, we saw increased M&A activity, and some of the reasons for this was obviously the low interest rate environment that we've had, strong cash positions that a number of those biotech companies have experienced either pre-COVID or in the early stages because of COVID. And also there was an identification of the need for growth and pipeline diversification. So it primed the market essentially for deal making. What we do believe is that these drivers will continue into 2021. And there's been some forecasts suggesting that 2021, we really could see that incentivization that large cap biotech and also pharma companies will look towards M&A opportunities to bolster their growth. So there'll be obviously interest in these highly valued non-partnered pipelines, and some of the areas, for example, that they may be looking at that may be sort of seeing increased growth for M&A activity will be things like oncology, rare diseases, the neurology area, and also immunology. An example of also larger companies taking over some of the small companies that occurred in 2020, and we talked about some of the number of biopharma deals. Obviously, you can see there 34 occurred in 2020. And an example I'll just highlight was Gilead Sciences, obviously one of the largest biotech companies. It purchased a company called Immunomedics. Now, it purchased this company for US $21 billion in September 2020. What this acquisition meant was Gilead was able to add the top breast cancer drug to its suite of products. So what Gilead Sciences is looking to do is sometimes, whether it's not even entering that stage or looking at breast cancer in terms of research and drug development, it looked to obviously acquire the leader in that space, so it's a much smaller company relative to Gilead Sciences, and take them in and acquire them, and essentially now come out with a new leader within that particular space. Looking beyond, also in 2021, let's identify some of the key biotech sector drivers. And it's interesting to see there, though, in terms of the bearish view that coronavirus has. And part of that is obviously the fact that vaccines have been developed, treatments have been developed. Yes, there'll be continued work on them, but that won't be the driver of biotech. What the drivers of biotech is going to be is M&A activity, we've just discussed. Innovation is going to really drive the biotech area. And I think there is a sort of this inherent need now that the world has to continually develop and focus on treating vaccines and being ready for if there was another pandemic to occur. The financing environment, we've spoken about that. So the number of new companies that have listed, but also the number of deals that are occurring, and also the number of just money that's being pumped into the biotech industry, whether it be from private equity firms, whether it be from investors, public or private, whether it be from governments as well. And I think overall, something really important to consider is sentiment. Talking about what is going to protect populations, what is going to protect people, it's innovation within this part of healthcare. A question we often get, and the Cure ETF, as I mentioned, it tracks the S&P Biotechnology Select Industry Index. So this is the main index for biotech around the world, but it's only looking at US companies. So we often get asked why. Now, wanted to just highlight here, so this is within healthcare, the number of US companies that sit within the world total industry of healthcare. There's about 65%. So 65% of healthcare companies around the world are US companies. Now let's break this down even further and look at within biotech. 75% of biotech companies are listed in the US. So clearly you can see that there's a real focus needed just on the US in terms of biotechnology. Why is that? One of the key reasons is that the US is essentially seen as the gold standard. So in 2019, from a capital raising perspective, the US raises the most amount of capital. They had nearly $100 billion raised in 2019, and that accounted at that year for about 60% of total capital raised, and 40% of issue obviously are for the biopharma sector. You also see, and the real probably the bedrock and the reason why the US is the gold standard is because of the FDA. So any company that wants to obviously seek access to distribute their products into the US market, they need FDA evaluation. And so what happens is a lot of biotech companies, even if they're Australian companies, European companies, etc., they generally look to base themselves in the US for easier access to that FDA process and for also easier distribution and marketing to US consumers. You couple that FDA reliance that a lot of biotech companies have with the fact that the US market is one of the biggest markets for biotech companies and for drugs and drug treatment and vaccines, etc. You then find that the US is the go-to for biotech companies to list. And so that's why you actually see in this, the figures there at the bottom just show you that the Australian sector, biotech sector, is roughly around 10 times, or the US biotech sector, sorry, is 10 times the size of the Australian biotech sector. So you're looking at about 110 billion US dollars for the Australian sector in biotechnology, and about 1.2 trillion US dollars for the US. Now, coming to how you can access biotechnology. And we launched the Cure ETF, C-U-R-E, about 2.5 to 3 years ago now. This particular ETF is the only ETF listed on the Australian Stock Exchange that gives investors the ability to access the biotech sub-industry purely. There are other ETFs that are able to give you broad healthcare, but what we do find is you're generally not seeing the growth that you would essentially get by looking specifically at biotech. Now, within this particular space, you also need to consider why an investor may not simply look at buying a single stock. And I know in Australia, a lot of investors would say, well, do you know what? I own CSL. CSL, it's a biotech company. It's the largest company in Australia. That is how I'm getting my exposure. So what I wanted to highlight here is the benefit of looking at a broad, diversified basket of stocks versus just a single stock, because there is this idea called single stock risk. And if you're looking at biotech and wanting to gain exposure just to say a CSL, you generally find that you're not going to get that diversified approach. CSL may go through its peaks and troughs, and that's the idea of looking at a diversified approach, especially when we think about Cure, is you're not buying just the losers or just the winners, you're buying the basket. So what you can see here is, and this is over, let's look at this looking back, over 1 year, so this is to the end of February, the Cure ETF returned at 37.5%. Now, CSL, had you owned it, returned over that 1 year, 12-month period, negative 14.3%. So there's about a 50% differential if you looked at it just from those numbers there. But the other number I wanted to focus on, beyond just looking at CSL, was broad healthcare. So that's that middle, that's the black line there that you see on the chart. It's the S&P Global 1200 Healthcare Index. So this is your broad healthcare. So before, when I talked about biotech is a sub-industry of healthcare, healthcare covers pharma, life sciences, biotech, etc. But really, you didn't see much benefit of holding a broad healthcare had you held it for that 1 year. You know, the difference in performance is close to 36% across the board between holding just a pure biotech ETF versus the broad healthcare. And that's why we sometimes say that biotech really is the growth driver and the innovation driver of healthcare. Just coming to that point also in terms of looking at single stocks. So we talked about CSL, and you can see there, you know, about a 50% return differential between the stock price of CSL versus the Cure ETF. But I actually wanted to talk about the idea of how hard it is to pick a winner. Now, what we've done here is we've essentially said, what was the year-to-date the best performing stock, the year-to-date worst performing stock within the biotech industry, and looking at the last year's best and last year's worst performer, and just seeing the difference. So, for example, if I'd invested in a company called Immunovant last year, or year-to-date, sorry, it would have been a negative of 71.7%. But had I invested for last year and taken my money out at the end of the year, I would have come out with a return of close to 191%. Really big differences there in terms of those figures. The same thing goes with Novavax. You know, year to date, it's done okay. It's done very well actually in returning 41%. But last year has returned 2,700%. Now, will that return occur this year as well? Will we see a repeat? And I think that's important to understand is when we're looking at taking an exposure to an area that can have failures within that research and development process, just think back to the fact that only 12% of drugs go from the start to being an approved product by the FDA. You're really putting all your eggs in one basket, essentially, is what's occurring if you're buying the single stock. So what the idea behind the ETF is, it gives you a diversified view across the sector. Now, since the inception of the Cure ETF, and as I mentioned, we launched it in November 2018, so just under 2.5 years that the fund has been listed here in Australia, you've seen that it returned an annualized performance of 23.9%. Now, that's a performance better than taking broad healthcare, but also better than looking at the S&P 500. Wanted to just touch on the methodology behind this particular index and the ETF. So the ETF is a pure full replication strategy. We essentially track the underlying index in its complete entirety. So this particular index, as I mentioned, it focuses just on companies that are classified within the GICS biotechnology industry. They have to be listed within the US, and they have to have a minimum market cap of $300 million if they're an existing constituent. But if they're a new constituent trying to come in, they have to have a minimum market cap of between $400 or $500 million. So these aren't small companies in terms of micro caps as we might know them. They're not sort of a very just, someone in a lab just trying to develop a particular drug. What we generally find, and I'll just run on this particular slide for the minute, is it is generally small caps and mid caps. So a small cap is identified as being a company that is less than US $2 billion. A mid cap is between that $2 to $10 billion mark. So about 89% of the portfolio sits within that mid and small cap space. And currently there are 169 constituents that sit within the portfolio. Just on the holdings, I just wanted to highlight this being the top 10, but something to note is the particular portfolio is equally weighted. Now, the reason why we equally weight a portfolio is for that same approach. It is not our job to try and pick out the winners or losers. We efficiently want to try to spread the exposure in growth areas where smaller players can essentially be the source of the unique innovation and growth. So what that means is performance is not overwhelmed by a small number of companies. So generally you may find, as companies grow and become bigger, they're the ones that are just contributing majority to a fund's performance. But also what that could mean is there's a lot of risk that's then applied in that if that particular company starts to underperform, it also will detract and be the major detractor to the fund's performance. So if all stocks contribute equally to returns, it avoids that bias to size. It also has more of a value focus instead of a momentum focus. And I think that's really important as we start to see this rotation shift from growth to value overall in markets. Finally, coming back to this particular slide, I just wanted to mention, we can see the top 10 on the left there. This particular ETF, it's rebalanced every quarter. So every quarter, there'll be a rebalance on the underlying portfolio. Also, when you looked at the underlying sub-industry groups that occur, that exist within the ETF, you can see a majority of the stocks are related or classified as being in that medical or biomedical gene area. But you also, as I mentioned, have a number of companies that may sit within that medical drug space or within the therapeutic space. But then you go down the line looking at the medical lab and testing and diagnostic kits and also that drug delivery systems as well. So it's not purely just biotech companies in terms of that medical or biomedical gene area. Now, quickly, before we run out of time, I want to give people a chance to ask some questions, but I just wanted to highlight 3 names. I know I spoke of a few of these names already, but Vertex, so this sits within that medical, biomedical gene sub-industry group. It's roughly around a 0.8% holding. Again, there's 169 names within this particular ETF, but this Vertex drug, it sells, the underlying main drug that it sells, it treats cystic fibrosis. So the main drug that it has is a drug called Trikafta, and in Q4 2020 alone, they generated sales of just over $1 billion. Now, something that's really interesting with Vertex that I wanted to highlight was it's looking to leverage its expertise in cystic fibrosis treatments in other genetic diseases. It's also collaborating with what I talked about, that CRISPR therapeutics. So on a gene editing therapy targeting red blood diseases and sickle cell disease. So you generally see a company like this has done very well in the area of cystic fibrosis and now expanding out, and again, using innovation to expand out its areas of treatment. Gilead Sciences, I have spoken about this, the use of its Velcluri or remdesivir, which is essentially a drug that was originally developed to treat Ebola. It's been authorized for temporary use, to treat COVID-19 in approximately 50 countries worldwide. But Gilead is much bigger than that. We talked about its recent acquisition within the breast cancer space, but also it has 16 FDA-approved drugs looking at HIV, oncology, hepatitis C, and one of its newest drugs is looking at rheumatoid arthritis, and that's going through the approval stage at the moment. It should be near that sort of end stage. And finally, I just wanted to touch on the third company, which is Regeneron. Now, Regeneron is a very interesting company in the sense that it has 8 FDA-approved medications already, and it looks across cancer, asthma, pain management, and infectious diseases. And one of its best successes is obviously its Eylea treatment, which is for eye diseases. In the pipeline, though, in addition to these existing drugs, as I mentioned, it's got 7 treatments and some are currently in phase 3 testing, and they've also patented DNA sequencing technology. So again, not just looking to develop certain treatments, but also to look at developing technology as well. And that's really why you sort of identify that biotech is really this innovation driver within healthcare. Now, how to use biotech within your portfolio? At the outset, this is a growth play within healthcare. You could see there just from the performance alone over 12 months, the fact that it has outperformed broad healthcare by nearly 36% suggests that. As a growth exposure, it also means that it has some inherent volatility attached to it. And we've seen that with some of those single stocks when we looked at it, some stocks being up 2,000% for last year, for example. So this is a satellite exposure. It sits to complement your core holdings within a portfolio. But what I would say is, depending upon where you sit on the risk profile and how much risk you are willing to take, you essentially can either sit this as a replacement for healthcare. So really, this is your healthcare tilt. And so what we wanted to show you here on this chart is how it would interact if you held on the left here. You can see just holding the S&P 500, which is the total US, the broad US market index. And the end chart is just saying you're holding just the biotech index. So you can generally see there that each time you start to allocate to the biotech index, your volatility increases. So again, for those that have an ability to ride and take that volatility within their portfolio, their reward is there. So it's that risk reward metric that you need to look at. So every 10% allocation to biotech increases the returns, but also gradually increases the volatility within this particular theoretical portfolio. So again, it's a complement to your core holding. It may not be unless you're very bullish on the biotech sector and that is the only exposure you want from the US, then it may be your US exposure completely. But what I generally see is it's being used as a satellite. And then the other side of it is, well, some investors say, well, I like the idea of the industrial nature of healthcare, but obviously it's not delivering me returns. It's not giving me the performance that I essentially see that a biotech product has. So what we find here is, again, small allocations to the biotech index sees increased volatility within this theoretical portfolio, but it also sees an increased dramatic return as well. I'd like to leave it there. I know there are a few questions that are coming through, but what I might do is I might give everyone just a minute now just to send through any questions you may have.
And Kanish, just to jump in here, 'cause I've been reading the questions as they've been coming throughout the presentation, and I can see there's a question here about the dividend on Core, if it pays one, and if so, how much and how often. So essentially, any dividends that are received within the fund, so from the companies that it has in the holdings, will be passed on to investors. So it does pay a dividend. However, the fund is much more targeted to growth. So the dividend on this fund is only small. Over the last 12 months, I believe it's around 1%. So it's not an extremely high yield. As Kanish has talked about, this is more of a growth-focused fund, but there certainly will be passed on to investors if there is any dividend paid, and that's paid out on an annual basis as well.
Now, I'll probably jump in just to answer the next question, which we've seen is why there's so many companies that feature in this portfolio. And yes, there's about 169 companies at the moment that are within the index and therefore are within the ETF. What we found was with an area like this, where you need to have a diversified view across the entire industry, that is one of the best ways to take exposure to it. Because if you're just taking this pure subsector play, which essentially is what this is, we didn't want to have an index which tried to cull out or tried to remove potential stocks. So therefore, to take full exposure to the industry, you're seeing the need for there to be 169. Now, I'd like to point out that we actually have seen that number of companies grow. So that's a positive for us as well, is the biotech industry in itself, it's the one that's receiving the most focus, and it's the one that's growing the most, not only in terms of performance, in terms of returns on the underlying stocks, but in terms of the number of companies that are being listed within this particular space as well. So that is one of the reasons why there are that many companies within the ETF.
So guys, if there's no more questions, we'll finish up there, but thank you all for joining us. Please at any time feel free to send through any questions to that info.au email that you can see on screen there as well. Obviously also welcome to give us a call at any time, and you can always find more information on the website. But thank you again for joining us. There will be a bit of a survey when you close the webinar. If you don't mind spending just a minute or two filling that out for us, we'd really appreciate it. And thank you again.